you've got questions, well, we have the man to answer those questions, Jeffrey Levine from Buckingham. Jeffrey, welcome back to another episode of Ask the Hammer.
Good to be with you,
There it
sir.
is.
Hey, there it is. All
There it
right.
is. Never far away, Jeffrey. All right, the reader question goes like this. I understand that Secure Act 2.0 will allow distributions of up to $2,500 per year from retirement accounts to pay for long-term care insurance premiums starting in 2026. Is this a good idea?
Well, maybe. Unfortunately, that
Better
is
than
the
it
answer a lot of
depends.
times.
Maybe.
Yep, right. It depends. Yep. And look, it comes down to, do you want long-term care? And where are your potential sources of income for which to pay for it? Ultimately, this isn't a tax-free distribution, right? So it's still going to be subject to income taxes. It's just saying you won't have a penalty on this amount. If you don't have another place to go, then yes, this would make certainly a good place if you want that type of long-term care coverage. But if you have other sources of cash to which to pay, that is often better so that you can leave your retirement dollars alone for retirement. And ultimately, after 59 and a half, which is when a lot of people do pay for these long-term care policies, it doesn't matter anyway. Because again, this exception isn't getting someone out of taxes. And I've seen a lot of people get that incorrect and say, oh, I heard you can take money out tax-free. No, no. It's a exemption of the 10% early distribution penalty, which simply says if you're under 59 and a half, then in addition to your regular tax, you have an additional 10% penalty. That would not apply here in the future. But again, that's still going to be a taxable distribution. And if your income is currently high, you may not want to add any more income to your year's current total.
Yeah. Do you think about it this way? If someone's contemplating how much money they would need to pay for long-term care needs, that it might be a small price to pay that ordinary income tax to get the coverage that you need for the possibility of needing long-term care?
I think if you're looking at buying a long-term care policy, then it's worth evaluating, what are your potential sources of income? But there are really like two questions almost in the question you asked. Like one is, should people get long-term care? And then two is, where should they pay for it from?
Yeah.
And the first one, should people get long-term care? Again, this is a, case-by-case evaluation, but I think it's fair to point out that the majority of Americans who do live to an extended age will need long-term care of some sort. This isn't like homeowners insurance where you're less likely to need it, than you are likely to need it, or a car insurance where, over time, hopefully you're less like with long-term care, there's a really high likelihood that that you will need coverage at some point, again, assuming you live to a nice, healthy age. Now,
Yeah.
by contrast, or not, I should say by contrast, but let's say you've decided now that you want to pay for this long-term care policy. The next question really becomes, what is the optimal place in which I can pay for that policy? Is it out of current income? Is it out of savings in the bank? It is out of my retirement account. If you have particularly low income, like for someone maybe who's retired early at 55 and they have this money in an IRA, that may be an opportune time to use some of those dollars. Maybe they don't have any other income right now. So taking some money out of a retirement account while their income is relatively low may have a very, very minimal tax impact, and they get out of the 10% penalty thanks to this exception. Of course, in the future, not yet today, but a year or so from now, they'll be able to do that. But that's really the two key discussions are, am I willing to take on this risk without long-term care? And if I do want some sort of coverage, then what is the best place for me to take the money in order to pay for this policy? And the nice thing here, Bob, is that is a year-by-year exception. So if you didn't choose to do it this year, but you want to take money out of your retirement account next year to do it, you'll be able to do that as well. It's not a once-in-a-lifetime thing. It's an ongoing annual exception to the 10% penalty.
Yeah. Well, there's no exception regarding like whether we'll answer a question or not, right? We just will.
No, we will take them, and no penalties. That's it. We don't impose penalty. You can ask as many questions you like. Give us a shout. Email us at askthehammer@buckinghamgroup.com. Again, give Bob and I a shout. Email us at askthehammer@buckinghamgroup.com, and we look forward to seeing your questions in our inbox real soon.